Welcome to the Whitwam Wealth Real Estate Podcast. Today our episode is the housing market going to crash in 2025?
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and today's podcast is the housing market going to crash in 2025? Today, we're tackling one of the most common questions out there. I get asked this from buyers, sellers, and investors. Is the housing market going to crash in 2025? So let's look at some of the data trends. Let's talk about this topic and figure out where we're going to go. Let's go beyond the headlines. And then, of course, wouldn't be my podcast if I didn't provide some of my own analysis. So let's talk about the current housing market. Where are we at today? It's very interesting because home prices today, if you've been out looking at homes, you realize that home prices are elevated compared to just a few years ago, which is very interesting in relationship to the fact that interest rates are higher than they were a few years ago. I hear many people talk about how high interest rates are, but we got to remember that as home prices have risen, interest rates are what we would call relatively high. What does that mean? They're high compared to what they were in 2020 and in 2021. So when we look at the comparison between the two, we realize that, hey, there's a pretty good size, differential. But I remember back in 2005, I got a 6.875% interest rate on a home purchase. And that's about where the market has been bouncing for, most of 2025 is between the 6.5% and 7%. I got 6.875% interest on extremely good credit, on full qualification, having full down payment, had everything. And you know what I thought? I thought this is the greatest interest rate I have ever had. I had never had a home mortgage that low. Now, there's a whole generation of people out here in the housing market now that have never seen an interest rate that high until recently. So it's a different buying market. And the differential is what's really causing the problem. It's not really the interest rate itself, it's the differential. The differential between what people currently have. So there's a lot of people out there like me that got sub 3% mortgages. I have investment properties with 3% interest rates on them. Why would I want to either sell a home that I have a 2.5 or 2.75% interest rate on and go buy another home and get 6.5 to 7%? That's almost a 4 to 5% interest rate differential, which is a massive amount when you're talking about the cost of a new home. So home prices are up comparatively, but so are interest rates. And that's creating a supply and demand imbalance. Again, we got some very interesting dynamics going on because, again, we went through such a period of several years where we had sub 5% interest rates, that now we've got the home prices that have come up in part due to inflation over the last 2.5 years. But we have supplies that have been growing nationwide. And we have a demand that has actually dropped nationwide, not because there's not buyers out there that want to buy houses. But there's buyers out there that would like to buy houses, but they've been priced out of the market, not necessarily because of the price of the homes, but because of the combination between the price of the home and interest rates. So let's just do a little bit of a comparison to the last couple of years. When we look at 2025 compared to just a few years ago, we see that home prices have had a steady increase. Now, in 2020, 2021, first part of 2022, we were seeing incredibly rapid home appreciation. Home prices were going up. About March, April, May of 2022, we saw interest rates start to go up dramatically, and we saw home sales begin to slow consistently in accordance with that. But the interesting thing that happened is home prices continued to grow. Now, their growth was slowed, but post-pandemic higher mortgage rates have kind of cooled the demand, which when demand cools, you generally think that prices slow, but that hasn't happened up until we got into 2025. So 2023, 2024, and as we were coming into 2025, demand because of mortgage rates had really slowed down. The real estate market had gone from being an incredible seller's market back in 2019, 2021 to being what we call a buyer's market, simply because sellers couldn't sell, which gave some options. But for the first year of that into the end of 2023, we had really low inventory, so there wasn't much for people to look at. But that's all changed. Inventories have started to come up comparatively. We have nationwide, we have much higher inventory rates. Buyer demand has ticked up a little bit, but not consistent with what we would perceive or expect in a market like we're in today. Buyers are still sitting on the sideline. There's been a lot of talk about lower interest rates coming, those type of things, but we haven't seen any of that. So when we look at prices nationwide, we see that prices have been fairly what I would call steady as we go into the mid part of 2025. We'd had appreciation even during the slowdown in 23 and 24. We came into 2025 and prices had kind of stabilized, had become steady. But what we've seen in the last probably 60 days is we've started to see some pricing pullback. We've seen houses sitting on the market longer, days on market have increased. We've seen sellers willing to give up more in concessions to buyers, and we are starting to see price reductions on properties that have been on the market for a while. And now we're seeing new properties that do come on the market being much more competitively priced. So we're starting to see some pullback in pricing. So there's been some changes that in the marketplace, but we haven't seen a dynamic drop in price. So let's talk a little bit about interest rates and how it affects affordability. Federal Reserve's decisions don't directly affect mortgage rates. There's been a lot of talk out there. The administration's pushing the Federal Reserve to lower interest rates to meet their dynamic, I would say, monetary policy, and try to utilize it to help stimulate the manufacturing growth and employment. And the Federal Reserve has been pushing back and saying, no, they're still trying to hit a target rate of 2% interest. They don't know how tariffs are going to affect inflation, and so they've been very adverse into lowering mortgage rates. There are many that believe that this is a political move because we saw right before the election, we saw the Fed cut interest rates by a half point without having their interest rate target be achieved, without employment hitting the benchmark for them. So there's those on the side that say this is political. There's others that say, no, this is actually hedging against the potential monetary changes of the new administration and their tariff policies, and the fact that there's some dynamics in the market. But when you look at it, inflation on the consumer goods is way below 2%. I think it came in at like 1.3%. Inflation itself is hovering around 2.3 to 2.7%. And the Fed really should go back and take a historical look at where they were. We saw inflation in this country at 9%. And in states like mine, the inflation rates were as high as 16%. We were a little bit higher than the national average. And so baked into everything that's out there now, from 2022 through 2024, is about a 30% or better inflationary number. Everything costs more from this period. And the fact that we haven't specifically hit 2%, but we see this downward trend, the Fed should be looking at making some move. But will that help mortgage rates directly? Well, no, because the mortgage rates are driven by mortgage-backed securities. And so when the Fed lowers rates between banks, the markets will react then to the Fed changes based upon what they see as the financial market going forward. Generally, the Federal Reserve decisions will either be a leading or trailing indicator of mortgage rates. I do expect that if the Federal Reserve was to cut interest rates next month by a quarter point, it would have very little effect on our current interest rates, because I think that when the Fed spoke in August, back in August, they indicated or they signaled that they were likely going to be lowering rates in the coming months, and the mortgage markets reacted to that, and we've seen some pullbacks on mortgage rates. Whether they'll be stable or whether they'll be permanent, we have to wait to see, because it's going to depend, again, on the Federal Reserve's monetary policy in September, October, and obviously November. So all of this is creating an affordability challenge for first-time buyers. As long as interest rates remain high, it's much more expensive for somebody to get into the market since home prices have appreciated. Many are being priced out of the market. And the reason is because if you think about it, on a $100,000 house, a 1% change is an additional $1,000 per year, or about $90 a month in their payment. On a $400,000 house, that could increase, your payment on a 1% change, by $400 a month. Well, right now we're 3 to 4% higher than we were. So on the same $400,000 house, you're looking at an additional $1,200 to $1,500 additional mortgage payment than what we saw back just 4 years ago. And it's not necessarily how high the price is, but the price of the money in order for most people to purchase it. One of the good things that we're seeing is that incomes have increased. Now, they haven't been able to keep pace with the inflation that we had from 2022 through 2024 under the previous administration. Under the Bidenomics policy of 30% inflation, most earnings, most people's incomes, most people's paychecks are not reflecting an equal amount of increase. In fact, as we saw household incomes during that period of 30% inflation decrease for the average American in those 3-year period of time. So we had cost of goods, housing included, going up on an average of 30%, but we saw incomes decreasing by about $2,500 per family per year. Now, we've seen a correction in that. We are seeing now that incomes are coming, household average incomes are increasing even in the first 7 months of the new administration with the new policies. This will help to offset some of the interest rates. We're starting to see interest rates come back down. Last report that I looked at, Freddie Mac, we were hitting about the 6.5% average in the market as of when I'm doing this podcast. So some of these things will help to bring some stability for new home buyers to make it more affordable. Even if a house costs $500,000, if you can get the interest rate down 1%, that's $5,000 a year in just interest payments, which is substantial because that's, like I said, about $480 a month on your mortgage payment. So lower and stable rates going forward would create more demand because it would give more buying opportunities to first-time home buyers, but it would also shrink that differential that I talked about earlier. When you shrink the differential, it makes it more sensible for somebody who's got a 2.5%, 3%, 3.25% mortgage to sell that and then take on a higher mortgage if the spread, that differential, isn't so significant. This lower interest rates, I think, would be the biggest stabilizer to avoiding a large correction and even a crash in 2025. the longer the Fed holds off on lowering bank rates, I think you're going to see the mortgage-backed securities continue to hold off from dropping down dramatically. I really think that the market, you're going to find a really stable market when we get into the mid fives, which is about another whole point to the low fives. You're going to see it really stabilize the market. I remember back, I think it was, I'm guessing now, probably back around 2014 when we came out of the crash of 2008. That one lasted really, we were doing short sales up through 2012, 2013, pretty strong. And interest rates had pulled back. And by, I think, 2013, 2014, we were in the fives, and we started to see a stabilization. We started to see a correction in the market. And I think you'd see the same thing here. I think if we get interest rates down to 5.5, 5.25, you're going to start to see a stabilization in the market. I want to thank you for joining me on this episode of the Whitwam Wealth Real Estate Podcast. Check out our previous episodes of related real estate investing topics. I invite you to subscribe today and be part of our growing community. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.